Welcome back. We have a big beat in the U.S. jobs numbers. We're going to tell you what those numbers are. We're going to show you the U.S. futures in just a moment as well. 353,000 jobs were added to the U.S. economy during the month of January. That is very close to double the 185,000 jobs that were expected, according to a poll of economists by Bloomberg News. We also get a big upward adjustment to the December number. The December number now stands at 333,000 jobs added in December. You can see the S&P the Dow contract rather plunging on this news. There's the S&P 500 contract also plunging on this news. That December number well ahead of the first number that was reported of 216,000. So the theme is clear. A U.S. jobs market that in both December and January was much, much stronger than expected. There's the U.S. dollar rallying in a big way on this as the market quickly resets its expectations for where the U.S. Fed is going on interest rates. We have a couple of experts standing by. One, of course, is Nathan Tuft. He is Chief Investment Officer at Manulife Investment Management and a Senior Portfolio Manager. The other is Lauren Saidel-Baker. She's an economist at ITR Economics. We want to welcome Lauren to the program. Thank you so much for making time for us, Lauren. Your quick thoughts on what we have seen thus far.
Well, you're right. This is a huge beat, but what this doesn't change is the fact that it is still an incredibly tight labor market. The Fed really does need to see a little bit of cooling growth in the labor market before I think they'll be really comfortable cutting rates. But overall, I don't think this really dissuades them from probably a second quarter rate cut.
The market, as we noted, is always quick to reset its expectations on what the Fed is going to do. The market appears to be betting on a delay to an interest rate cut. You don't see this news as nudging the Fed one way or another, do you?
Well, it certainly gives them a little bit more ammunition. I don't think they're comfortable with the current rate of wage inflation. They do want to see inflation continue to cool off. Overall, this is really good news for the consumer. We do still see wage inflation outpacing consumer price inflation. So that's going to keep a little bit more oomph behind the U.S. economy. Really not the same kind of cooling that we would expect to see.
And we're seeing yields as well, the two-year yield jumping up to 4.35%, up 15 basis points. Nathan, your take on what we've heard so far?
Definitely big numbers. It will be interesting to drill in to see what the breadth of those job upside is from the perspective of where they're coming from, because that's an important theme as well, just how broad that breadth is. But very hot numbers. In our view, it definitely pushes the Fed. We never were in the camp that there's a March hike on the table. That's almost certainly off the table in our view at this point in time. But we too believe that the Fed will still have the opportunity to cut rates in the second half of this year, but perhaps it's just delayed a month or two as this data continues to come in a very healthy way.
Lauren, what are some of the factors that make it a very tight labor market? You said in a recent note, you phrased it as it remains an employees market with many companies struggling to hire. Why so?
That's absolutely true, and it's driven by demographics. We just don't have the same number of new workers waiting in the wings, ready to come into the labor market. Gen Z, who's now entering the labor force in large numbers, is just a much smaller generation. So we don't have that same replacement for the baby boomers. So today we still have over 8 million unfilled positions. That's 1.4 job openings for every unemployed worker. The ball is still very strongly in the employees' court.
And what about wage growth? Wage growth, you noted, continues to outpace inflation. How difficult is it for the Fed to get inflation down to 2% if wage growth remains significantly stronger than that?
Well, inflation is headed in the right direction. So we do have disinflation, which is going to give them just a little bit more comfort. I think we're getting closer to that target range. But you're right, the stickiest aspect of inflation right now is in that wage inflation segment.
Nathan, same question to you. How much of a headwind is wage growth in the U.S. to the Fed and its mission to bring inflation down?
It's a key focus. Inflation overall is the primary driver that's going to allow the Fed to move or not move. And we do still think there's disinflationary pressures in place. And we have seen wage growth come off its high levels of inflation, but it's still uncomfortably too high for the Fed to be particularly confident in doing significant cuts quickly. And so our general view is it is the key focus area for the Fed. It's the inflation numbers and specifically the wage inflation that's going to be a hot button for them when it comes to the timing of their cuts.
Here's a bit of a breakdown on the different numbers. Total private sector employment, 134,000 jobs. There was a big tick up in construction jobs, one of the top sectors in terms of growth, and manufacturing jobs as well. Any surprises there, Nathan? You were wondering earlier about the breadth of the advance.
That still sounds pretty good breadth. I mean, obviously, there's still a lot of jobs that are being generated by the government. But at the same time, with that participation, that does look pretty healthy to me from the perspective of being better than expected when it comes to the breadth overall.
Lauren, where are we headed on this over the next year or so? What kind of employment trajectory do you see?
Well, with the cooling macroeconomy, I do expect some pullback in this very, very tight labor market. But coming from such a strong starting position, it just won't do all that much damage. So I do still expect general tightness, especially compared to history. That's good news for the consumer. It's tough news for companies, but the consumer is really the engine driving the U.S. economy. So I think this is giving us broad-based strength to our economy overall.
Nathan, how do companies adjust here? And does it have an effect on corporate profit margins?
I mean, it has an effect, but to me, the theme is going to be companies having to spend more money on productivity gains through other measures, i.e. the tech sector and AI, and trying to figure out ways to cover that shortfall of supply when it comes to the working population that was mentioned. And so generally speaking, we think this requires companies to actually spend more in order to get other ways of getting that productivity they need outside of just hiring another person.
We began our morning, Nathan, by talking about the tech earnings this morning, driven in large part, in the case of Meta and Amazon, earnings growth by very significant job cuts announced by both of those companies. Why is the tech sector an outlier here, cutting jobs in a very tight labor market?
Well, I think it comes to the fact that they overhired during the COVID dynamic. And so in some cases, they're right-sizing their hiring from what they did over the course of 2020 through 2022. And so that's part of the story. But the other part of the story we talked about earlier is companies are becoming more capital disciplined in the tech sector, and they're being more conscious about their cost structures. And so to me, the tech sector is a little bit of an anomaly because they're correcting something that they've made a mistake on by overhiring. At the same time, they're becoming more capital disciplined in their cost structure.
Lauren, we hear a lot about illegal immigration, a lot about it these days in the U.S. What about legal immigration? Is the U.S. government bringing in enough people with skills to fill the jobs that are vacant?
No, and I think that could be one solution. We need demographics to support these labor needs for our corporations, and we just don't have quite the numbers today. So that's one potential solution. Otherwise, we could go back 20 years and have more babies, but absent a time machine, I do think immigration's a more logical solution.